Will SOFI be a $15 stock by 2025? You see, after releasing my latest video on SOFI where I talked about its business and projecting its business for the years to come, one of the most common questions I actually got is where would this company find itself in 6 months to a year? Since becoming public, SOFI has actually fallen from a high of over $28 all the way down to $4.20. And despite closing at $8.05, they still find themselves down 71% from all-time highs. And on top of all of that, SOFI has been trading in a range bound regularly between $7 and $10 for the best part of 2 years. And so the question remains, is SOFI a broken stock? Or is there something more? And that is what we aim to answer in today's video. You see, in investing, right, markets tend to misprice companies very regularly, often being either too optimistic or overly pessimistic on a company. While it is a fool's game trying to call the top and bottom of companies, what we actually can do is look at how the company has been performing and determine what is a suitable price for the company. And thereafter, one of two things can happen. Firstly, we can definitely be wrong on our assumptions, and that means that we have to relook at our assessment of the company and find out our mistakes to learn and to adjust. However, a second possibility is that we are correct on our assumptions and we just have to wait for the rest of the market to realize what we see in the company. And that has been the story for every single big company that we know today, from Amazon to Microsoft and Tesla, and even most recently Nvidia. So there are definitely potential catalysts on the horizons for SOFI, especially as the rate cut cycle begins. But as always, potential is a dangerous word, so let's dive in. Now, to answer this question, I'm going to break it down into 3 segments. The first thing we're going to talk about is what can go wrong, what can actually potentially keep the stock price depressed for longer than expected. The second thing we're going to cover is basically the upcoming catalyst for SOFI. What are the tailwinds that we expect going into 2025? And finally, we're going to end off on talking about what people actually think about the company. In the last 1 to 2 months, right, Anthony Noto has been on many programs, many interviews talking about SOFI's business and how they are basically on track to achieve what they have set out to do, and at the same time also clarify some of the doubts, some of the concerns that people have about the consumer and about a potential recession. And so I know it's quite confusing to actually follow all these interviews. I'm actually going to clip out some of the best parts of the interview, some of the core parts of the interview, and talk about them and use them to answer this question for us. Now, after listening to all these interviews that Anthony Noto has been giving, I basically think back about my model, and I actually think that, I have to input some of the changes and model out some of the things that he has actually told us in this interview. So stay tuned for that. But first, let's talk about what can go wrong. And the biggest risk facing SOFI at the moment, and the biggest risk that investors are concerned about, is the possibility of a recession and how that affects their business. Now, if you take a look at SOFI's business, right, you realize that they are dependent on a strong consumer. And the fear is that in a recession, delinquencies will rise, less people will take out loans, and that will be a hit to both their top and bottom line. So if you take a look at this graph, the grayed out portions actually represent periods of recession. So you can see we have one in the 1990s, in the early 2000s, the dot-com bubble, 2008, that is the most significant one, the one that is most obvious, that is the Great Financial Crisis. And we actually see a smaller one here in 2020, which is during the pandemic. So you can see, right, in all these periods of recession, what happens is that we can see a spike in delinquencies of varying degrees, and the only exception is the pandemic in 2020. Because people were cooped up at home and many companies had to shut down, the whole economy basically came to a standstill. So there was definitely lesser opportunities for, spending in terms of buying a big ticket items. And because of that, there's lesser need for people to take out personal loans and things like that. So it's not like you take out a loan to buy things on Shopee and Amazon. At least I hope not, right? Otherwise, we have bigger problems to deal with. Now, here is what Anthony Noto has to say about the health of the consumer and a potential recession.
Consumer activity and sentiment is trending okay. And I think as long as the Federal Reserve cuts rates 25 to 50 basis points, that trend will continue. A couple of data points that we're seeing that should be instructive for the audience is what's going on with the SOFI member. Again, a SOFI member is a higher income member, higher credit, but it is indicative of some part of the market. We're seeing debit spend continue to be very strong. It was strong in Q2 and continues to be strong in Q3. But importantly, that debit spend is not coming at the expense of deposit growth, which also remains strong.
Now, let me summarize very quickly what he just talked to us about in 3 talking points. The first one being consumer sentiment. Anthony Noto basically tells us that the consumer sentiment will be okay as long as the Federal Reserve cuts by 25 to 50 basis points, which we actually heard on last Thursday. We got a 50 BP cut. So that means consumers should be okay going into 2025. Now, Anthony Noto actually backs this up by telling us that he actually sees debit spend going up along with deposit growth. This is an important note that I think a lot of people actually just gloss over and miss. Now, why is this important to me? Because in a recession, right, what we're actually worried about is that the consumers eventually use up their savings and end up defaulting on their loans. But what Anthony Noto is seeing is that the SOFI consumer is spending, and so the spending of the SOFI consumer is going up. But not only that, the deposits are actually growing, not shrinking. So that is actually a positive sign. Now, finally, he actually also mentions that the type of consumer SOFI is serving, right, is not, fully representative of the middle class of the Americans. And, the SOFI customer generally belong to the more affluent group, and so they are less likely to be affected by a recession. You see, the average SOFI member has a FICO score of 745, and this means that they are less likely to default on loans. And I think that, I've mentioned this before, if you consider two households, one with a monthly household income of $4,000 a month and another household with a monthly income of $20,000 a month. Now, suppose that during a recession, right, both of these households actually see one job loss, which means that their household income would be halved. Right? So the family whose $4,000 is reduced to $2,000 a month will be more materially affected than the family whose $20,000 is reduced to $10,000. That is because, they can probably still comfortably live off $10,000 a month, and, with their high earnings, basically that has given them a runway to build up savings for rainy days like this. Now, Anthony Noto actually gave us even more reason to be confident, even if we find the US entering into a recession. Now, in this second clip, right, Anthony Noto stresses that people are still misunderstanding their business. They are judging SOFI as a lender. However, lending is now only 50% of their revenue, down from over 99% when he first took over. And usually in a recession, it is the lending segment that causes the most concern and poses the largest risk to the company. So people need time to adjust their perspective on SOFI.
Yeah, I think this quarter is definitely a milestone quarter. When people sit back and do the work, they'll realize the magnitude of the transition we made. We had record revenue, as you know, almost $600 million, up 22% year over year. That would have never happened without us driving diversification outside of lending, which only grew 5%. The financial services sector grew 80% year over year, and it's driven by both 40+% product growth and 29% growth in revenue per product, both of which will continue to propel the growth of the overall company. I do think there's a legacy of us being predominantly a lender. On the earnings call, as a matter of fact, we had analysts ask questions. 99% of them were about lending. There was only one question about the financial services segment, and their focus continues to be on the thing that we used to be as opposed to the thing that we've become, and we're trying to emphasize the magnitude of the innovation we're driving.
And so in Anthony Noto's perspective, we just need to give people time to adjust their perspective on SOFI. You see, what people don't realize, right, is that as the financial services and their tech platform grows, lending will have an even smaller impact. And their long-term goal is to actually have all these three components contributing equally to revenue, which means a 1/3 split in each of lending, financial services, and their tech platform. So their other arms of the businesses will basically cushion the impacts of lending in a recession. But don't take my word for it. Here's what Anthony Noto has to say on Bloomberg.
Over the next 5 years, I would expect our growth to result in revenue that's about 30% financial services revenue, 30% tech platform revenue, and 30% lending.
You see, the reason why I actually showed you this clip on Bloomberg, right, is because I just want to remind us that in a recession, it is not just people that stop spending. Companies actually stop spending as well, which could affect their tech platform. And if you actually follow my last video, you actually realize that one of the concerns I have is about their tech platform.
The second element would be, as you mentioned, the technology platform business, which we believe is a mid to high teens grower for the rest of this year, for the full year, and then going to 20% growth next year as we have a great backlog of partners coming online, hopefully in 2025.
So Anthony Noto has actually guided that the tech platform will grow by about 20% or so in 2025, and he says this is due to a backlog of clients which they have not managed to onboard enough. Now, I've already, complained about them not onboarding their client fast enough, and this is basically proof of that. But this is at the same time also a source of comfort because, having a backlog tells me that there is demand through to 2025, and the reason why he can project a 20% growth in the tech platform is not because, they are confident of their ability to go and secure new clients. In fact, they actually already have the clients and they just need to onboard them in 2025. And so to summarize all of that, right, is there recessionary risk? Is the recessionary risk real? Definitely it is real. However, SOFI protects itself against the risk in three ways: by having a high income, high quality consumer, by having diversified sources of revenue, and by having a backlog of demand in terms of their tech platform. Let's talk about the three upcoming catalysts that Anthony Noto has been talking about as the reasons to why SOFI is on track to achieving their targets. And the first one being rate cuts. Now, what does rate cuts actually do for SOFI? Rate cuts basically help them to do three things. The first one, it drives demands for more loans. The second thing that rate cuts do is to allow SOFI to sell off their existing loans at a higher profit margin and at the same time lower their cost of lending. Now, naturally, right, if you cut rates, there will be a greater demand for loans. This is quite straightforward to understand. And so let's listen to what Anthony Noto has to say about this.
Yes, absolutely. The day that we had the yen carry trade disruption in the marketplace where we saw rates drop significantly, we saw a doubling in our mortgage locks per day. Now, our mortgage business isn't huge, and that trend wiped away the next day when rates went back up.
Now, if you remember, right, I actually pointed out that back in 2019 or 2020, they actually suddenly grew their mortgage loan by 3 times in a year. And he's basically hinting at the same thing. During the yen carry trade, he actually told us that when rates fell, he actually saw a doubling in the demands for their mortgage and mortgage refinancing within that day itself. Now, why is there such a big demand for mortgage loans? You take a look at the chart over here. Actually, for anyone that has been buying a home in the last 2 years, right, you're paying a mortgage rate of over 6%, and so because of that, as interest rates come down, people are incentivized to refinance their home and to basically get a better rate. Now, that is just scratching the surface, and I want to do a deeper dive into Q3 earnings before October, but broadly speaking, SOFI needs to sell off some of their loans to be able to give out more loans eventually, and if they can sell off these loans at a higher profit margin, then the better for them, right? Additionally, why is there a sudden demand for their loans? Now, if you consider this, when the US Treasury, right, was offering a risk-free rate of 5%, why would you want to take on, additional risk for 8 to 9% yield by buying SOFI's personal loans? However, if the risk-free rate suddenly drops to around 2%, then suddenly the 8 to 9% yield that you will get by buying SOFI's personal loans may seem more attractive to you despite the risk, and hence more people will look to buy these loans off SOFI, which would drive up their margins. Why exactly do SOFI need to sell loans? Now, very simply put, right, let's say I have $100, I loan out the money to you, and you have to pay it back with 10% interest. Now, at this point in time, I can do one of two things. Either I can sit around, do nothing, and wait for you to actually pay me back the loan, the $100, together with the 10% interest, right, and receive a total of $110. Or I can actually go and find someone else and say that, hey, you know what, I lent Asing some money. He's going to pay me back with interest, so he's going to pay me back a total of $110. Why don't you pay me $105 today, and then you collect the loan back from Asing, so you earn money, right? You pay me $105, but you collect back $110. And so this is what SOFI essentially does, right? They actually loan you the $100, they actually sell off your loan, collect back $105, and immediately they take this $105 to lend it out again. Now you go and find someone else, and let's say Abeng, hey Abeng, I'm going to lend you $105, right? And so this $105 will generate me another 10% interest, which means at the end of the loan, now I will receive 10% of the $105, which means I will receive an interest of $10.50, plus Abeng still has to return to me the $105, now making SOFI's profit, or my profit, eventually to be $115.50 instead of $110 if I were to just hold on to the loan initially without selling. So if I can't offload the loans, right, then it is harder to actually give out new loans, which is why it's important to note that in the last 3 quarters, SOFI has managed to sell $4.7 billion of their loans, and this is a big increase from 2023 when they've actually found it hard to sell their loans. So by selling off their loans, it basically gives SOFI the ability to actually originate more loans moving forward, which Anthony Noto has already told us there's great demands for their loans. Now, SOFI doesn't actually sell off all their loans. Now, why is it so? I'm going to explain it in a bit, but basically they keep a lot of their student loans on their books. Now, if you take a look at this chart over here, right, and this is by one of my favorite sources when it comes to SOFI news, data-driven investing. I'm going to link his newsletter and his X account down below. So if you are not followed yet, please do go and follow him. But let's take a look at some of the charts that he has actually done up for us. It basically simplifies a lot of my research process. Now, basically in data-driven investing research, right, he shows us that the personal loans that SOFI hold generates them an interest of about 12%, and the student loans have a 4 to 5% yield. So the question is, why is SOFI, seemingly so willing to sell off a higher yielding loan by selling off all their personal loans and keeping student loans? Now, this is actually very simple for safety. You see, as you can see, right, the default rates for personal loans is 5 to 6 times that of student loans. And so basically to them, it is not worth the couple, extra percentage points of yield if the default rates are going to be so much higher. And so additionally, right, by having these student loans on their books, this provides SOFI with a more stable net interest margin, even in uncertain macroeconomic conditions, which is what people are actually worried about when they talk about a recession. Because unlike personal loans, right, you cannot just write off your student loans so easily. So even if you're declared bankrupt, you can't just write off your student loans. And I mean, we can actually see this by the court ruling recently against the second attempt at student loan forgiveness. So it comes to the third thing that actually benefits SOFI when the rates are lowered, which is lower lending costs. This is the juicy part that actually generates more money for SOFI. When the Federal Reserve lowers its interest rate, right, it lowers the cost for SOFI to actually lend out money. Remember the example I was talking about earlier where we lend $100 to Asing with a 10% interest, right? So where did this $100 actually come from? Now, it came from actually someone depositing their money with me, or in this case, depositing their money with SOFI. And let's say, I have to pay the depositor 5% for them to deposit their money with me. And so when Asing eventually pays me back the $100 with the 10% interest of $10, I have to return $5 as interest to the person that put their deposit with me, which means that I get to keep only $5 as my profit. However, let's say when the Federal Reserve lowers their interest rate, I'm also able to lower the interest that I actually pay to the depositor. And because of that, when people deposit their money with me, let's say I'm only saying, hey, when you deposit your $100 with me, I will give you 2% interest. And because of that, right, I do the same thing. I lend out the $100 with a 10% interest. And now, instead of keeping $5, I get to keep $8 and increase my profit margins. And that is essentially what is happening with SOFI right now. So if you take a look here at their Q2 earnings, right, SOFI has different types of deposits, and what you actually notice is that they reduce their time deposits. So time deposits, in Singapore is also called fixed deposits, right, from over $3 billion at the end of last year to $1.8 billion within the last 6 months. And they actually have another $1.2 billion reaching maturity by the end of the year. And so time deposit is basically a higher cost deposit, a higher cost of capital compared to, normal bank deposits. And by reducing their higher cost deposits, right, and increasing their lower cost deposits, by driving their normal savings accounts and things like that, SOFI is able to eventually generate a higher profit margin. And so the second tailwind that SOFI actually has is, being able to sustain a higher APY. When asked about APY, right, basically Anthony Noto sets us up nicely by talking about the growth of the company and why, if we take his word for it, and I feel comfortable doing so because of his track record so far, SOFI can really see an acceleration in growth. So let's listen to what he has to say.
If it lowers, how competitive do you have to be to keep that money flowing in?
Yeah, we think we'll still have a very competitive APY in a declining rate environment. Several of our businesses will benefit meaningfully from a lower rate environment. The loans in our balance sheet will be worth more, everything else equal. Home loans will actually see more refinancing, and that business should benefit for greater demand, greater marketing efficiencies, greater flow through. Also, our student loan financing business would benefit. That will all allow us to continue to maintain a very high APY relative to competition. Many of our competitors that offer an APY that's even close to ours, we're at 4.6% if you do direct deposit. We're still superior to others, but those that are close to us will struggle to keep the same rate and the same premium because they're not origination platforms. So we benefit from both those businesses working well together.
And so basically what Anthony Noto is trying to tell us, right, he basically pointed out that because SOFI is a fintech, they are able to maintain higher rates over legacy banks due to the high expense of a legacy bank, right? And because of that, the legacy banks are more inclined to reduce interest rates and reduce their APY in line with what the Federal Reserve is doing. So thus allowing SOFI to keep their APY higher for longer, winning over more customers. At the same time, when comparing to other fintechs, right, that offer a similarly high APY, Anthony Noto basically believes that SOFI's edge is their banking charter, allowing them to originate loans at a lower cost compared to other fintechs. And the whole play is for them to maintain a competitive APY longer than their competitors to eventually gain market share. Now, finally, right, I also want to talk about how analyst projections can potentially help us get SOFI to $15, right? Now, because institutional ownership has actually gone up to over 45% over the last couple of months. But at the same time, when you look at some of the analyst expectations, right, it's absolutely ridiculous, you see. It's almost as if these institutions want to intentionally scare people, keep the price for as long as possible so that they can keep on buying. Or, of course, it could be like what Anthony Noto said, they just don't understand the company fully. Now, from the way I see it, right, valuation is made up of two components. There's the sentiment and there's execution. So sentiment refers to the multiple people actually place on your company. And so for companies like, Alibaba and PayPal, both of them have their issues. And so despite having strong earnings, what people do is that they place a very low multiple on these earnings, and so you get a very low stock price. However, I think in SOFI's case, it's a little bit different because for companies like Alibaba and PayPal, what happens is that the only remedy to that is time. And basically, it takes time for the companies to turn around and for sentiment to change. But in SOFI's case, if you take a look at metrics like price to sales, price to tangible book value, SOFI definitely seems undervalued in those metrics. But if you look at the PE ratio, right, because everyone is so focused on profitability, we actually see that, perhaps sentiment isn't that bad. Take a look at the average analyst projections, right? They basically projected 2024 SOFI to come in with a 10 cents EPS and a price target of $9, which means, right, using this and working backwards, you get a PE ratio of 90. And if you take the analyst high-end estimate of $13 per share at 11 cents EPS, that is a PE ratio of 118. Or on the low end, analysts that expect SOFI to be $4 per share with an EPS of 6 cents, right, actually give us a PE ratio of 66. So you see, the thing is, when I did my own valuation, right, I've used PE ratio between 15 to 30, and in that video, I actually used the sector average of 50 as well. So from these analyst projections, you can actually see that they're actually okay to assign a pretty decent PE ratio to the company, which means that what they're having problem believing is management's growth numbers, and this is always the case with every growth company, right? And every company that succeeds have to go through this phase. You see, what this company has to do, or what SOFI has to do, is to continue proving to Wall Street that they can sustain this growth for a long period so that eventually Wall Street will believe them and assign them the correct multiple. Let me put into context a little bit what the analyst expectations actually mean for SOFI, right? So you see, the analysts on average expect 2024 EPS to come in at 10 cents. And so I want to preface this by saying SOFI has always beat earnings ever since they turned public. So with that in mind, let's take a look at what these analyst expectations mean. Now, in the first 2 quarters of 2024, SOFI's EPS came in at 8 cents and 1 cent, making a total of 9 cents in the first half of 2024. They also guided for the third quarter EPS to basically come in at 3 to 4 cents. So on average, the analysts are expecting SOFI to miss their Q3 earnings for the first time in their history, and not just a slight miss, a miss of 75%. Not only that, by expecting a 10 cent EPS, right, which means that SOFI will actually make 9 cents for the first half of the year, 1 cent in Q3 of 2024, and they will not be profitable in Q4 of this year. And if these two things happen, then the average analyst projections will come true. And for someone who has basically followed the company for the last 2 years, that really seems very crazy. What I want to do is to apply Wall Street's PE ratio to management's actual projections and guidance and see where that takes us. So if you take a look over here, I'm just going to very quickly remind us, for the analyst high-end projections, they're actually assigning 118 times PE to SOFI. For their average projection, they're assigning a 90 times PE to SOFI, and for their low-end projection, they're still assigning a 66 times PE to SOFI. And what I'm going to do is to take a 20% margin of safety on all of these PE ratios, which means for me, in my projections, I'm going to use a high-end estimate of 94 times PE, average estimate of 72 times PE, and a low-end estimate of about 52 times PE. And so the first case that I want to run through with using all these P ratios, right, is the analyst's best case scenario for SOFI. If SOFI actually does 1 cent of EPS in Q3 and another 1 cent in Q4, that will make their total EPS in 2024 11 cents, which is the highest end of the analyst estimate. And using the multiples that we actually just talked about above, you will actually get a high-end estimate, a high-end price target of $10.38. The average price target for SOFI will be about $7.90, which is around where we are today at $8.05, and a low-end estimate of $5.80. And in this case, which means that from today's value, we actually have a 27% downside risk. However, if we expect SOFI to actually meet their expectations in Q3, which means coming in with an EPS of about 4 cents, and in Q4, an EPS of 3 cents, that means SOFI's full year EPS would be 16 cents. Now, assuming the same multiples, right, the high-end estimate for SOFI's price would be about $15.10. The average estimate for SOFI's price would be $11.52, and the low-end estimate of $8.45. And so this means that, if SOFI continues to execute and Wall Street notices them, and then it's fair to say that, SOFI can easily be between $11.50 and $15 by 2025. But you see, for me, right, I don't like assuming this multiple because it's really just a wild guess what people will assign to them. I actually like to drill down into the actual tangible metrics of the company company and go from there and let people assign whatever multiple they want to assign. Because valuation, in my opinion, needs to be more nuanced, and this is really just a simplified version to show you the glaring disconnect between the price and the performance of the stock. So that is why I think it's important to consider these other things in your SOFI valuation and model, and to actually see how they can actually potentially go past $25 by the time 2026 comes around. And I talk about it more in the next video over here, and I'll see you in the next one.